Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
All right, welcome to your U.S. market update. The three leading U.S. indexes closed at record highs on Thursday as investors shrugged off concerns tied to a U.S. government shutdown that had entered its second day. The S&P 500 inched up 0.06% to close at 6,715. It was up 0.3% at the day's peak, reaching a fresh all-time intraday high. The blue chip Dow climbed 0.17% to finish the day at 46,520, while the tech-heavy Nasdaq Composite rose 0.4% to finish at 22,844. The tech-heavy index also saw a new intraday record as well, supported by a gain in NVIDIA shares, which also reached an all-time high as investors continued to pile into the AI giant. For more insights on what's happening stateside, we have on the line now Chris Weston. He's the head of research at Pepperstone. Chris, thank you for coming back on the show.
My pleasure. Thanks for having me on.
Yeah, let's touch on the government shutdown first. We had Treasury Secretary Scott Bessent telling the media that U.S. economic growth could be hurt by the government shutdown, so voicing concerns about GDP. Donald Trump has touted the shutdown as an unprecedented opportunity to cut Democrat agencies, and we've also seen the consequence of that in some respects. The Energy Department's cancelled about 300 funding awards to projects in 16 states, and that's kind of slammed the brakes on efforts to reduce carbon emissions and whatnot. Do you see any kind of cascading effects of this shutdown right now?
Not in the short term. You know, we did see quantitative information yesterday that for every week that it goes on, they're estimating it's going to shave off about $15 billion worth of GDP. But if you use the sort of the last episode in Trump's first term, in the second shutdown that he had in 2018, 2019, we saw GDP was a lot lower in that stage, but we saw about 11 billion being shaved off through the shutdown. It was a 35-day shutdown, one of the longest we've seen. And so that equated to about 11 billion. But once you get the backfills and back pays and people being made right, the net effect was about 3 billion was lost off US GDP. So it was actually a sort of negligible effect. I think probably the big concern we have here, we're not really looking for growth to really come under major pressure, and growth in the US at the moment is actually in quite a good spot. It's these hardball tactics, which we're sort of unsure if it's going to happen or not, where Trump's threatening something like 750,000 people potentially to be permanently furloughed. So I think that could be somewhat more of a market story if it was to happen. We don't know if it's just Trump being really hardball with his negotiation tactics. But from a growth perspective, I think the longer it goes on for, it will have some impact. But I don't think it's going to, it's certainly not going to impact recession fears or anything like that. So we're pretty sanguine about the whole situation, to be fair.
Yeah, fair point. What is the market's current expectation regarding the timing of the government reopening? We've heard anywhere between 3 and possibly up to 11 days, and the consequent impact of key data releases like NFP, which has obviously been delayed from today, and CPI ahead of the next FOMC meeting.
Well, on the second point, market participants, including myself, we lack patience. We want the information right here, right now, because it helps us with our understanding and how we can manage risk. We want to know that we want certainty. That's what we're trying to price. And if that certainty is being delayed because a report such as the payrolls number, which is so important for the Fed's thinking around whether we get a rate cut in October, potentially in December, it's a key piece of economic data that we really, we're not going to get. So we've just been sort of transfixed on other things like, the ADP payrolls number, which we wouldn't usually look at too closely. But that was very poor earlier in the week. And we might look at things like the ISM services numbers, which are out tonight, and we'll look at the employment subcomponent. And we might raise our sensitivities around that when we probably wouldn't look at it too closely compared to the payrolls number. So it's annoying because it's frustrating. It is what it is. But we're not going to get this key information at this time. But I will also state that the next Fed meeting is on the 29th of October. So, if the government reopens, we should get that non-farm payrolls number before that. And so the Fed should have enough information to make an informed decision of whether they're going to cut rates in October. Look, the rates market and the swaps pricing at the moment seems to think it's a done deal anyway. They've probably got enough information as it is. I mean, we're pricing 98% probability that the Fed cut in October. And there's a 90% chance that the Fed cut in October and December. There is no November meeting. So, the rates market and swaps traders do believe that the Fed already have enough information, and they should also the government should open up in time to release that, so the Fed have that information for the next meeting. Now, on that point, the first point of your question, anywhere between 3 and 11 days seems reasonable. I think if you have a look at the volatility curve, what's being priced for specific dates, we do start seeing a normalisation and volatility around the 15th of October when the CPI numbers come out. So that suggests that the market is expecting some sort of agreement and the government to reopen within sort of 11 to 12 days or something like that point. So that's kind of realistically what we're going to be expecting.
Yeah, anyway, between 3 and 11 is nowhere near the 35-day record we hit in the 2018-19 shutdown. So that should, I guess, leave some optimism in the markets, which haven't historically been too affected by shutdowns in any case. But moving on to that point, despite concerns about valuations and crowded trades, it seems like the buy everything trade is continuing in the markets. Why is that, Chris?
Well, I think, I think a lot of people hedge out any kind of risk through gold. I mean, everyone, man, woman and dog owns a position in gold either through ETFs, ETPs or futures or from, CFDs or some sort of derivative product. And, I think that's one thing. People have started increasing shorts in US dollars. Perhaps there's a little bit of a hedge there against the yen. But I think, the AI trade is really very well subscribed at the moment. We've seen so much information about deals being done, whether it's anything to do with OpenAI. We saw Oracle's recent massive corporate bond issuance coming through. There just seems to be deals being done, capex levels being increased. Nvidia has just pushed to a new all-time high. We're sort of questioning whether that can continue to $200. Intel is just ripping to the upside. It's going absolutely bananas at the moment. AMD looks good. Broadcom, they're all looking pretty good at the moment. You're spilling over into China. Some of the Alibabas and Tencents are looking absolutely strong as you like. And so I think there's just so much underlying momentum. I mean, it does scare me because it's a similar sort of thing as we saw back in February where everyone was all in on the tech trade and the AI semi-trade. Then it was DeepSeek came and that was the sort of trigger for a liquidation coming through. We don't know what that negative catalyst could be. And obviously if we knew it, then we'd be trading it. But, the risk is at the moment that everyone's all in. There's huge crowding in the trade. And it does scare me that if we were to see something negative really drop, then it can come around very, very quickly. But at the moment, we don't know what that is. And, the market's sensing a fairly low probability it's going to happen at this stage.
Yeah, you're also keeping your eye on the cryptocurrency momentum, Bitcoin in particular. How has Bitcoin's recent performance compared to precious metals, for instance?
It depends which metals you're looking at. I mean, everyone's been focused on the platinum and silver move, which have just gone parabolic. And, we are seeing a little bit of heat coming out the silver move now. People are looking at the longer-term charts and seeing a sort of a rerun of what we saw in 1980 and 2012, which didn't end too well, to be fair. I don't think that the fundamentals are similar as what we saw then. And I think the move is completely justified and it's been a momentum chase. But, crypto has underperformed gold and these markets. And, they have a very sound investment case, the crypto, the precious metals markets. And that's been then driven by huge inflows into ETFs and ETPs and into futures markets. There's a lot of momentum sort of based funds sort of chase the market higher. But crypto's now found its form. I mean, it had a huge washout of leverage long positions, sort of 19th of September, and we saw it drop down to, or Bitcoin, if we use that as a proxy, to 109,000. And that sort of gave everything a bit of a cleaner structure. A lot of those leverage positions got washed out, and we didn't see that sort of extended positioning. People have bought back in, and we're trading, sort of around 120 on Bitcoin now, and we're up 7 days in a row. And that sort of momentum has generally or historically been a very strong precursor of future appreciation in the crypto price. So, we're running the numbers this morning. We saw that there was 21 occurrences where Bitcoin since 2020 has gained 7 days in a row. And in 90% of those occurrences, the price was higher 10 days later. So, momentum is generally a very good indicator of where prices may go for crypto. And at this stage, people are coming back in. It's got a much cleaner structure than what we've got with gold, where everyone owns it. And we suspect that there's a higher probability that we can continue to push to an all-time highs here.
All right, we'll wait and see whether there's any more upside on the horizon for Bitcoin. But in a nutshell, Chris, in the current market environment, how should investors be positioning themselves?
Well, it's really difficult because it feels so hard to chase these markets higher because we're at very lofty levels and very, very rich valuations, very rich crowded positions in US equities. Chinese equities have done very well. Hong Kong done very well. So buying into markets now is a very, very hard thing to do. But, I think I think there's still further upside in these markets. I'll be still very cognizant of going or staying away from anything in the energy space at the moment. The oil price looks very weak. But I think if I'm in positions at the moment, I'm staying long and just looking at my risk and, understanding if things do roll over, I want to lighten up and be very quick to do so. But buying pullbacks in the equity market is the trade for me. So any kind of weakness in Nvidia, AMD, all these stocks, the momentum stocks, any kind of weakness is a buying opportunity for me, and that'll give you a cleaner position. Gold's the same. I want to see a bit of a flush out of long positions in gold, and I think that would give an opportunity to come back in and get back in. So I think anything that's working at the moment is doing so for a reason. Just wait for a bit of positioning to come out and rejoin the party. All
right, Chris, thank you so much for your insights this morning.
Pleasure. Thanks for having me on.
Cheers. Have a good day. That was Chris Weston, Head of Research at Pepperstone, and you're listening to Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3.